Every system of money begins as a tool and ends as a test. When governments first issue new forms of currency, they talk about convenience, stability, and progress. The language is always the same. It's about helping citizens, modernizing the economy, fighting crime, increasing inclusion. Almost no one stands up at the podium and says the quiet part. Every upgrade in money is also an upgrade in control. Central bank. Digital currencies, CBDCs, are presented as the next logical step. Just a digital version of cash, we are told. Faster payments. Cheaper transfers. More efficient monetary policy. Harmless. Inevitable. But history says something else. Whenever a state gains finer control over money, it eventually uses that control in ways people did not expect when the system was introduced. Paper notes were once a convenient replacement for gold. Over time, they became a way to separate citizens from any hard anchor. Income tax began as a temporary wartime measure. It quietly became permanent. Emergency financial powers were introduced just for a crisis. Then they became tools in normal politics. CBDCs fit the same pattern, a technology wrapped in reassuring language, offering real benefits but also opening doors that, once unlocked, rarely close again. This is the story of central bank digital currencies in 15 hidden facts. Some are technical. Most are structural. All are about how a small, quiet change in how money works can become a big, loud change in how power works. Hidden fact 1. CBDC isn't just another app. It changes who you bank with right now. Most people hold money in commercial banks. Your paycheck arrives in your bank account, not in an account at the central bank. Cards and apps are just layers on top of that. Even when you tap to pay, you are using private intermediaries that sit between you and the monetary authority. A CBDC shifts that relationship. In its purest form, it means ordinary people and businesses can hold digital balances directly with the central bank. Instead of relying only on private banks, you could, in theory, have an official wallet at the core of the system itself. That sounds simple. In practice, it redraws the map. The institution that sets interest rates, prints money, and manages systemic risk would also hold your balance. It would see flows in real time. It could, depending on design, alter conditions on your money directly in ways that were never possible with paper cash or banknotes in a safe. Hidden fact 2. The efficiency pitch hides a data revolution. CBDCs are often sold as a way to make payments faster and cheaper. No more waiting days for transfers to clear. No more expensive intermediaries. Instant settlement. That part is plausible. Digital systems can move numbers quickly, but the same infrastructure that moves money instantly can also record everything instantly. Cash is anonymous by default. Card payments and bank transfers leave trails, but those trails are fragmented across thousands of institutions. No single actor sees the entire picture in perfect detail. With a CBDC, especially one run on a centralized ledger, the central bank, and anyone who can access its data, can see a unified view of who spends, where, and when. That data has value. For risk monitoring, tax compliance, and crime prevention, it looks like a dream. For privacy, it looks like the end of off-the-radar everyday life. The trade-off is not a theory. It is built into the architecture. The more efficient and integrated the system, the more complete the data set. Hidden fact 3. Programmable money is a feature, not a bug. One of the most powerful and least discussed aspects of CBDCs is programmability. Unlike paper notes, which are inert, digital currency can be given rules. It can be designed to expire after a date, to be spendable only in certain places, to be blocked from certain categories of goods, or to trigger alerts when thresholds are crossed. Central banks and policymakers talk about this as a tool for good. Imagine stimulus payments that must be spent quickly to boost the economy, or disaster relief funds that can only be used on food and shelter. Imagine automatic tax collection with no complex forms. From a policy perspective, it is extremely attractive. History, however, is clear. Powers created for limited, benevolent purposes rarely stay limited. If money can be shaped to encourage good behavior, it can also be shaped to punish bad behavior, and who defines those terms can change with elections, crises, or ideology. Hidden fact 4. Financial history is full of temporary measures that never reversed. CBDC proposals are often framed as experiments, pilots, or options for the future. Governments reassure the public that they are just testing, that use will be voluntary, that cash will remain. We have seen this movie before. Income tax, in several countries, began as a temporary measure to fund wars. Capital controls were introduced as emergency responses to crises. Extraordinary surveillance powers were justified after terrorist attacks. In many cases, the expiry dates slipped quietly into the background. The measures stayed. The pattern is simple. Once a tool is built, it becomes very hard for any future government to give it up. There will always be another crisis, another justification, another exception that slowly becomes the rule. A CBDC infrastructure, once installed, will be available to every future administration. However different its values may be from the ones that designed the system. Hidden fact 5. Past episodes already show what happens when states get fine-grained monetary control. Central bank. Digital currencies are new in form, but not in spirit. History offers earlier versions of what happens when governments gain tighter control over citizens. Access to money. In the 20th century, several countries responded to banking crises by freezing deposits, limiting withdrawals, or devaluing currencies overnight. In Lebanon, more recently, ordinary people woke up to find that they could no longer freely access their savings. In Cyprus, during its crisis, large depositors saw haircuts imposed on their balances to rescue the system. These actions were blunt because the tools were blunt. With CBDCs, the same kind of power could be exercised with precision. Instead of closing all banks, limits could be applied to specific groups, regions, or transaction types. Instead of across-the-board devaluation, targeted adjustments could be made silently in the background. The question is not whether governments are capable of using money as a control mechanism. They already have. The question is what happens when their instruments become surgical. Hidden fact 6. CBDCs blur the line between monetary policy and personal life today. When central banks try to stimulate or cool an economy, they mostly act through big, abstract levers: interest rates, bond purchases, reserve requirements. The effects reach individuals indirectly. Through banks and markets, a CBDC can, in principle, make those levers personal. If authorities wanted people to spend more, they could issue time-limited digital credits that decay if not used. If they wanted to discourage certain types of borrowing, they could restrict how CBDC balances interact with specific lending platforms. If they wanted to penalize saving too much, they could impose tiered negative interest rates on large balances. What begins as macroeconomic management slowly crosses into shaping the daily decisions of millions of individuals. The boundary between policy and behavior becomes thinner. The more direct the tool, the greater the temptation to use it at ever finer levels. Hidden fact 7. The promise of safety can become a trap. One of the strongest selling points for CBDCs is safety. Unlike money in a commercial bank, which can fail, a balance at the central bank can be framed as risk-free. In a crisis, people might be encouraged to move funds into CBDC wallets as a secure haven. But safety that depends entirely on a single issuer is a double-edged sword when everyone's savings sit on the balance sheet of the same institution. That institution's decisions, rules, and potential failures become systemic in a way we have never fully tested. If access is ever restricted, there is no alternative bank across the street. If rules change, everyone experiences the change at once. In previous monetary panics, people could flee from weak banks to strong ones, or from paper into cash, or from one currency into another. A mature CBDC system reduces some of those degrees of freedom. What feels like safety now can, under stress, feel like being locked in. Hidden fact 8. Cash will always be there is a promise, not a law of nature. Authorities often reassure citizens that digital currency will merely complement physical cash, not replace it. That may be true in the short term. Over the long term, the fate of cash is a political and economic choice, not a natural constant. We have already seen societies drift away from cash through a mix of policies and habits. Fees, limits on large cash transactions, and the closure of ATMs and bank branches all make notes harder to use. Once a critical mass of stores stops accepting cash, its practical role shrinks. If, on top of this, a CBDC becomes embedded in tax systems, welfare payments, public services, and everyday commerce, opt-out becomes difficult. Maintaining cash then looks inefficient or expensive from the state's point of view. At some point, a future government can argue that full digitization is simply modernizing. The promise that cash will remain has no force beyond political will. Hidden fact 9. CBDCs can centralize power even in systems that look decentralized. Supporters sometimes argue that CBDCs could be designed in a decentralized way using distributed ledgers, involving private intermediaries, or limiting central visibility. Those design choices matter. They can reduce some risks, but the defining feature of a central bank digital currency is in the name, central bank. No matter how many layers sit around it, the legal and technical authority for the core ledger rests with a single institution. Backed by the state's monopoly on issuing currency. History shows that when a central authority controls a vital network, whether it's railways, telegraphs, or payments, its formal independence can be narrowed in times of stress. Laws are rewritten. Mandates are expanded. Cooperation with other agencies becomes compulsory. Decentralized technology does not automatically produce decentralized power. The question is not which database architecture is used, but who can ultimately override it. Hidden fact 10. Emergency use cases will be the wedge even in skeptical societies. It is easy to imagine scenarios where CBDCs are introduced with broad support. A pandemic that requires fast direct payments to citizens. A natural disaster where existing banks are offline. A financial crisis where quick, targeted support is needed for households. In moments like that, speed and precision are everything. A digital system that can put usable balances into millions of wallets overnight looks like a miracle. Few people will argue against a tool that in the short term helps them survive, but emergency justification has a pattern. Measures introduced under extreme conditions often become permanent infrastructure. Once people grow used to the convenience, rolling back the system feels like taking something away. Future emergencies then trigger expansions of scope, not reconsideration. Over time, what began as an exceptional instrument becomes the default channel. Hidden fact 11. Historical experiments with total visibility have a consistent outcome at 20th century. Planned economies offered a primitive, analog version of what a fully surveilled monetary system might look like. States tried to know who produced what, who consumed what, and where every unit of output went. The goal was control and efficiency. The result was usually rigidity, corruption, and black markets. CBDCs do not create a planned economy by themselves, but they lower the technical barrier to attempting finer control. If every transaction is visible, there will always be voices arguing that the data should be used more aggressively to enforce price controls, to nudge consumption, to punish wasteful or undesirable spending. History's lesson is not that control fails immediately. It is that over-control suffocates the very adaptability that makes societies resilient. When every move is watched and regulated, honest activity goes underground or stops entirely. The map becomes perfect. The terrain deteriorates. Hidden fact. 12. The line between fighting crime and policing dissent is thinner than it looks. CBDCs are often justified as tools against money laundering, tax evasion, and terrorism financing. Those are real concerns. The opacity of some financial channels does facilitate crime, but the same mechanisms that detect and block criminal transactions can, in principle, be applied to other categories defined by law. If certain protests, donations, or organizations are ever classified as threats, the infrastructure that flags suspicious flows can be re-aimed. History is full of examples where yesterday's dissidents are today's heroes, and where laws drawn up for one purpose are used for another. When access to money depends on being on the right side of shifting definitions, financial control becomes a quiet form of political control. Hidden fact 13. Once behavior can be priced, it can be managed. A CBDC opens the door to dynamic incentives and penalties. Want people to buy less of a certain good? Offer discounts or impose higher transaction fees automatically. Want to encourage spending in one region and discourage it in another? Tweak parameters. Want to reward approved activities? Link them directly to bonus credits. Marketers already do some of this through loyalty points and targeted offers. The difference with a CBDC is that the currency itself can carry conditions, and those conditions can be set or influenced by the state. When every financial move can be made slightly more expensive or slightly cheaper with a line of code, the temptation to optimize society through small nudges grows. None of those nudges feels dramatic on its own. Over years, they can add up to a system where the range of truly free choices shrinks without a single law being passed. Hidden fact 14. Opting out gets harder the more integrated the system becomes. Right now, if you dislike a particular bank, payment app, or card network, you can move. Alternatives exist. Cash still works in many places. Physical assets, foreign currencies, and decentralized digital assets offer other ways to store value. If a CBDC becomes the backbone for salaries, taxes, benefits, and public services, opting out stops being a simple consumer decision. It becomes a form of partial exile from your own economy. You might still hold other assets, but your ability to interact with key systems will depend on accepting the central rails. History's pattern is that systems do not start with full integration. They grow into it. The first services are optional. The next become recommended. The final ones are required for your security and convenience. By the time people realize how narrow the path has become, turning back is expensive, lonely, and difficult. Hidden fact 15. The real risk isn't the first version. It's what comes after the first crisis most early. CBDC pilots and designs will likely be cautious. They will emphasize privacy, limits, and coexistence with cash. They will be rolled out gradually with voluntary adoption and friendly branding. The initial reality may look far less dramatic than the fears. The crucial question is what happens at the first major shock: a deep recession, a banking panic, a geopolitical conflict, a pandemic worse than the last. In that moment, the existence of a central, programmable, ubiquitous digital currency will look to policymakers like the ultimate emergency toolkit. Pressure will rise to use every available lever to freeze some accounts, redirect others, impose rapid stimulus, or punish behavior seen as dangerous. Once those emergency changes are made, they create precedents. The next government inherits not only the tools, but also the story that using them is acceptable when necessary. Over time, necessity expands. That is how slow decay turns into a sudden drop, not through a single dramatic flip of a switch, but through a series of reasonable-sounding decisions, each tightening the system a little more. Central bank digital currencies are not science fiction. They are being designed and tested in real institutions right now. They may bring genuine advantages: lower costs, faster payments, greater financial inclusion. They may also embed a level of visibility and control into money that no previous society has ever lived with at scale. The choice is not between panic and blind trust. It is between understanding the pattern and pretending it doesn't exist. History's lesson is simple. When a state gains new power over money, it rarely uses less of it over time. Constraints that are not written into the system up front will not magically appear later. Safeguards that depend on goodwill will last only as long as the goodwill does. The quiet inevitability here is not that CBDCs must lead to abuse. It is that, without hard limits and real alternatives, the pressure to push them further will always be there. If money becomes code, and the code is controlled from the center, then every transaction becomes a potential point of leverage. What you earn, what you spend, what you save, and where you travel stop being entirely your decisions. They become, at least partly, parameters in someone else's system. The clear message is this: before any society accepts a central bank digital currency as its default, it should decide, in law, in architecture, and in culture, how much control over everyday life it is willing to hand to whoever runs that system. Not just today, but in 10, 20, or 50 years. Because once the rails are built, once everyone is riding on them, it will not be easy to get off.